You move product. That's what people think this is. They think it's about the product, the kilo price, the markup between Sinaloa and Chicago. They think the margin is simple. Buy low, sell high, keep the difference. They think this is a business. It is a business. That's the problem. Before the first shipment crosses, before a single gram changes hands, before any revenue appears anywhere that could charitably be called a ledger, you are already spending. The entry cost alone, the bribe to the municipal police commander, the understanding reached with the customs inspector at the port of entry, the monthly envelope passed in a parking garage to the man whose name you will never say aloud, is not a startup cost. It is a recurring one. It doesn't stop, it accelerates. Call it what it is, payroll. Just payroll with no HR department, no documentation, no recourse. The structure of public corruption is more formalized than civilians understand. It is not chaos. It is a tiered system with its own logic, its own seniority, its own rate card. A municipal officer in a border town earns between $800 and $2,000 a month from cartel payments. Call it a supplemental salary, because that's what it functions as. A state police commander earns between $15,000 and $40,000 a month. A federal official with real jurisdiction, someone who can redirect an investigation, bury a file, stall an extradition, earns more than that, sometimes significantly more. And the relationship is not transactional, it is structural. You are not paying for a favor, you are paying for an ongoing exemption from consequence. This is the first thing the gross number conceals. When a journalist reports that a cartel moved $2 billion in product last year, they are reporting revenue. No serious financial analyst confuses revenue with profit. The bribery infrastructure alone, what insiders call the Plaza fee system, can consume between 15 and 30% of gross revenues in a given corridor. A plaza is a geographic operating license. You pay for it monthly. You pay the organization that controls it, the officials who enable it, and the local enforcement layer that ignores it. Miss a payment and the entire architecture collapses, your shipment seized, your people arrested, your competitors handed your routes. The plaza fee is not optional, it is the cost of operating inside the system. But let's stay with corruption costs for a moment longer, because the casual accounting always undercounts it. Beyond the regular plaza structure, there are episodic payments. An investigative journalist getting too close, that requires a payment. A government task force spinning up in the Capitol, payments to the right advisors to redirect it, payments to officials to manage the paperwork, sometimes payments to attorneys operating across the border to complicate extradition proceedings. Each of these is a line item. None of them appear in any accounting. And the rate always increases. Nobody in a position of corrupted power accepts a flat fee for long. The leverage goes in one direction. The second structural cost is security. This is where the mythology of the cartel, the gunmen, the convoys, the private armies, meets the operational reality. A mid-sized cartel operating in 3 states maintains between 300 and 800 armed personnel in active deployment. They are not working for ideology. They are working for a weekly wage that ranges, depending on rank and function, between $500 for a street-level lookout and $3,000 for a trained tactical operative. Leadership, the lieutenants who run plazas, coordinate logistics, manage local distribution networks, earns between $10,000 and $30,000 a month. Do the arithmetic. A security force of 500 people blended across that wage structure costs somewhere between $3 and $6 million a month. That is before equipment. Weapons, vehicles, communications hardware, body armor, these are not trivial costs. A cartel's logistics and security infrastructure in a single operating corridor can consume more monthly than a mid-sized American company's entire payroll. And unlike that company, you cannot reduce headcount by announcing a restructuring. The severance package for disloyal personnel is not a settlement agreement. This is not an organizational chart that tolerates efficiency reviews. Then there is the cost that every business has and no business likes to discuss: cost of goods. The kilo price from the source country, Colombia for cocaine, Mexico's interior highlands for methamphetamine, the poppy-producing states for heroin, is only the beginning. The product must move. Movement has a cost that is not shipping. It's the payment to the guide networks, the tunnel operators, the vehicle modification specialists who build compartments into fuel tanks and engine blocks. It's the cost of the legitimate businesses used as transit camouflage: the produce truck, the ceramics company, the dry goods importer. These are not cheap. A tunnel sophisticated enough to move product in volume costs between $1 and $6 million to construct. It has a functional lifespan measured in months. The first rule of cartel accounting: your cost of revenue is not the product price. It's the product price plus the entire infrastructure required to keep the product moving without triggering an interdiction event. And interdiction events happen. They happen constantly. That's where the shrinkage number comes in. Seizure rates for cocaine entering the United States are estimated by analysts to run between 10 and 15% of total volume. Some corridors run higher. The product seized is not just lost product, it is a cost multiplier, because the rest of the supply chain was paid to move it, the officials were paid to look away, and the shipment arrived nowhere. The revenue is zero. The expense was full. A cartel moving 1,000 kilos accepts that between 100 and 150 kilos will be seized, used as evidence, and incinerated in a federal facility. At street wholesale prices, 100 kilos represents between $3 and $5 million in foregone revenue, with the full upstream cost already paid. The industry term in legitimate business is spoilage. Here, nobody calls it anything. It just disappears into the number. The gross number always sounds spectacular. That's the number that gets reported. The net, once you trace the real operating structure, the corruption payments, the security payroll, the logistics infrastructure, the seizure losses, the construction of concealment systems, the maintenance of legitimate-facing businesses as cover, is smaller, often substantially smaller. Not always, but enough that the economics of this business are less about unlimited margins and more about survival inside an extraordinarily expensive operating environment. This is the machine underneath the machine, and you are only at the beginning of understanding what it costs. You don't have a CFO, you have a contador, an accountant who works without a computer, often without paper, and whose primary professional qualification is the ability to carry numbers in his head across 9 figures. He is one of the most important people in your organization. He is also one of the most replaceable, because if the numbers ever become a liability, so does he. There is no P&L, there is no balance sheet, there is a mental model, held across 4 or 5 trusted people, of where money is, what form it's in, and how fast it's moving. The absence of documentation is not inefficiency, it is the system. Every record created is a record that can be found. The cartel's accounting system is architecture designed around the impossibility of audit. This creates its own costs. Cash, physical currency in volume, is extraordinarily expensive to manage. You might be generating $300 million in annual revenue across a distribution network that reaches 30 American cities. Most of that revenue arrives as small bills, hundreds, 50s, 20s, not wires, not checks, not anything that touches a correspondent bank. Cash. The volume is not metaphorical, it is physical. You need space, vehicles, personnel, and a system to aggregate it, move it, and convert it into something that can be deployed without triggering a currency reporting event. Bulk cash smuggling, moving physical currency across the border into Mexico, where it can enter the legitimate financial system through a network of money changers, real estate transactions, and business fronts, costs between 5 and 10% of the value moved. That's not a fee, that's the market rate for a service performed at significant personal risk by people who need to be paid, secured, and trusted not to skim. If you are moving $200 million annually and laundering 80% of it, you are paying between $8 and $16 million for the privilege of accessing your own revenue. This is the cost that nobody includes when they report cartel revenues. The money isn't yours until it's clean, and cleaning it is expensive. Beyond bulk cash movement, the layering infrastructure, the businesses use to commingle cartel proceeds with legitimate income, carries its own operating cost. You are not simply fronting a car wash, you are maintaining a car wash that files taxes, employs actual workers, services actual vehicles, and generates a volume of reported cash income that can be blended with unreported income without triggering an audit. This means the business must actually function. You need a manager who is either complicit or uninformed. You need a revenue model that justifies the cash flow. You need a local presence that doesn't invite scrutiny. Multiply this across a network of 40 or 60 such businesses across 2 countries, and the overhead for maintaining your money laundering infrastructure is not trivial. It is a second business, a portfolio of legitimate businesses that exists primarily to launder the proceeds of an illegitimate one. The return on that portfolio, in terms of laundering efficiency, is rarely better than 80 cents on the dollar. You put $100 million in, you extract $80 million in usable, deployable capital. The $20 million is the operational cost of the system, the managers, the business losses, the compliance with actual regulations in the fronted entities, the attorneys and accountants working at the intersection of legal and illegal who charge rates that reflect the risk. Now look at what's left. Revenue, minus Plaza fees and bribery infrastructure, minus security payroll, minus logistics and movement costs, minus seizure losses, minus money laundering overhead. You are not looking at the number that was reported. Let's construct a rough model, a mid-sized cartel operation, not the largest, not a regional footnote, moving 800 kilos of cocaine per month through a single primary corridor. At a wholesale border price of $15,000 per kilo, gross monthly revenue is $12 million. That sounds simple. Here's what the actual P&L looks like. Cost of product at source country price, roughly $4,500 per kilo, so $3.6 million. Transportation and logistics infrastructure, the tunnels, the vehicles, the networks, the guides, 15% of movement value, or roughly $1.8 million. Plaza fees and corridor bribery, 20% of gross revenue, or $2.4 million. Security payroll, 800 personnel at blended wages, $4 million. Seizure losses at 12% of volume, approximately $1.4 million in foregone revenue at the border price, with full upstream costs already paid. Money laundering overhead at 20% of net cash, roughly $600,000. The total cost structure on $12 million of gross revenue approaches $11.8 million. That leaves $200,000 per month on a $12 million top line. The margin is not infinite. The margin, when you account for the actual operating costs of maintaining the infrastructure, is often below 5% on a volume basis. The businesses that survive are not the ones moving the most product. They are the ones who have paid down the infrastructure costs, the established tunnels, the long-running official relationships, the laundering networks built over decades, such that the marginal cost of each additional shipment falls steeply. This is the second rule of cartel economics. Scale is not profitable because of market power. Scale is profitable because the fixed costs of operating the machine are enormous, and once they are paid, additional volume flows through at dramatically lower cost. The cartel equivalent of operating leverage. Once the plaza is paid, once the security apparatus is established, once the laundering network is running, the incremental cost of the next 100 kilos is a fraction of the cost of the first 100. The first tranche pays for the machine. Everything after that is what keeps it worth running. But the machine also fails, constantly, in ways that don't show up in any accounting. A lieutenant arrested in Dallas, someone who knew a regional distribution network in granular detail, requires immediate response. The network is burned, new contacts established, new cells built, new relationships with local distributors formed from scratch. The cost is not an attorney fee, it is the lost revenue during the reconstruction period, the cost of re-establishing trust with buyers who went to competitors during the gap, and the intelligence cost. What did he give? What did he know? What has now been compromised? These events are not line items, they are category resets. An internal betrayal, a trusted regional coordinator who was also feeding information to a rival organization, produces similar costs but with a different character. The investigation required to identify the source of the leak, conducted internally and without any tools that could themselves become a liability, costs personnel time, interrupts operations, and almost always results in collateral damage. Innocent people inside the organization who were proximate to the compromised individual and are now automatically suspect. This is not a management consulting problem. It is an organizational continuity crisis that costs each time it happens between $2 and $20 million in direct and indirect losses. It happens regularly. It is priced into the model. The legitimate financial world has a concept called the risk-adjusted return. You don't just look at what an investment returns, you look at what it returns given the probability and magnitude of loss events. The risk-adjusted return of cartel operations, once you include operational disruptions, personnel losses, asset seizures, and infrastructure reconstruction costs, is considerably lower than the gross revenue figures suggest. Nobody is telling you this is unprofitable. It is profitable, but it is profitable in the way that a highly leveraged acquisition of a distressed asset is profitable. The upside is real, the downside is total, and the operating costs will consume you if you mistake revenue for income.
You don't think about the margin anymore. You think about the architecture. By the time you are operating at the level where decisions about corridor allocation, political relationships, and organizational succession happen, the day-to-day arithmetic has been delegated so completely that you receive a single number once a week, sometimes once a month, from someone whose primary function is to hold that number in his head. The number tells you how the machine is running. It does not tell you what the machine is costing you in ways that won't appear until later. Later always arrives. The mature cartel, one that has survived 15 or 20 years, that has outlasted rivals, survived extraditions, absorbed leadership voids, and continued to operate through changes of government, has a cost structure that looks nothing like the one it started with. The startup phase, brutal as it is, has a logic. You are paying for access, establishing presence, forcing an entry into a market that resists entry. The mature phase has a different problem. You are paying to maintain a position that has become enormously complex and that everyone around you is motivated at some level to erode. The official relationships you have maintained for a decade now cost more than when they started. This is not corruption inflation in the general sense. It is the specific logic of leverage inversion. In the early years, you needed the official more than he needed you. You were the petitioner. The relationship was asymmetric in his favor, and you paid accordingly, reliably, generously, on time. Now the relationship has inverted. He has accepted your money for a decade. He has done things that cannot be undone. He needs the relationship to remain stable as much as you do, and he will use that leverage to renegotiate upward because he knows that your switching cost, finding and establishing a new relationship at his level, is enormous. The bribery infrastructure matures into a protection racket. The officials who should fear you have learned to extract from you. You continue paying not because the relationship is productive, but because ending it creates an adversarial official with detailed institutional knowledge of your operations. The cost is not the payment. The cost is the loss of leverage over people who are supposed to be on your payroll. Meanwhile, the security cost has become structural in a different way. The armed wing of the organization, built to project force, defend corridors, eliminate competition, has developed institutional interests of its own. The men who carry weapons are not interchangeable. The ones who have risen through the security hierarchy have relationships, loyalty networks, and in some cases, independent income streams that you did not authorize. They are inside the machine. They are not decorative. And managing them, keeping them loyal, contained, and directed rather than entrepreneurial, is itself a full-time organizational function with its own cost. This is the cost that doesn't appear in any analysis of cartel economics, the organizational cost of managing a workforce that operates under constant existential pressure, earns its income in cash with no record, bears lethal personal risk, and has no legal recourse for any grievance. The turnover is not just deaths and arrests, it is the constant management of people who are rationally assessing their own position inside the organization against their alternatives. When a reliable lieutenant decides his alternatives are better, either with a competitor or in cooperation with federal authorities, the cost is not just the loss of a person, it is the loss of what he knows, which is a great deal, and the gain of an adversary with institutional knowledge, which is catastrophic. Loyalty is the most expensive input in this business, more expensive than the product, more expensive than the officials, and it cannot be stockpiled. It must be maintained continuously, at cost, with no guarantee of return. The seizure problem also matures in a counterintuitive direction. In the early years, seizures are painful but recoverable. You are not large enough that a single interdiction event threatens the organization. As you scale, the seizure exposure scales with you, but more dangerously, you become a priority target. The resources directed at you by enforcement agencies are not fixed, they respond to your prominence. The larger you become, the more expensive the interdiction apparatus directed specifically at your corridors. Shipments are watched that were not watched before. Routes that functioned for years stop functioning. The investment in new routing, new ports of entry, new concealment methods, new transit networks is not a one-time expense. It is a recurring research and development cost, and the useful life of each innovation is measured in months before the counterintelligence apparatus adapts. The drug enforcement community studies you. You are paying constantly to stay ahead of people whose entire institutional purpose is to understand and disrupt your operations. The asymmetry is not in your favor. They lose a case, they file again. You lose a shipment, you absorb the loss and rebuild. They learn from every interdiction. You are losing institutional knowledge with every arrest. The net present value of a cartel operation, calculated honestly, discounting for operational risk, leadership disruption probability, seizure losses, and the terminal value problem, is negative for most participants. The few who extract extraordinary wealth do so by exiting the operational layer entirely, moving into the political and financial layer where they are no longer carrying the operational risk but collecting returns from those who are. The men who survive with their wealth intact are almost never the men who ran the machine at peak. They are the men who converted operational proceeds into legitimate assets, real estate, political relationships, financial instruments, early enough that the transition preceded the inevitable organizational disruption. The business does not reward the best operators, it rewards the best timers. And somewhere below all of this, at the bottom of the organization chart, in a city that moves product it will never see the profit from, a young man with a street-level role is calculating his monthly earnings against his monthly risk. He is earning between $500 and $1,000 a month. His expected career duration, before arrest, violence, or organizational collapse ends it, is measured in years, sometimes less. He is bearing the maximum operational risk for the minimum financial return, in a structure designed to extract value from the base and concentrate it at levels he will likely never reach. He doesn't know the margin, he knows the cash in his hand. The machine tells him that is enough. It has always told him that. It has always been wrong. And somewhere above him, at a level he cannot see, someone is looking at the number that represents his entire earning potential and treating it as a rounding error on a line item in a mental accounting that will never be written down. The terminal margin is not a percentage, it is a life expectation. The machine takes another step forward. It always has, it always will. Not because it is profitable in the way that word is commonly understood, but because it is profitable enough for long enough for the people who design the structure and absorb the least of the cost, and because there will always be someone at the bottom who doesn't yet know what the numbers actually say. The badge always says first year. It always will.